Hello, I'm Dan Passarelli of MarketTaker.com here on the floor of the CME Group. Well, the market behind me here is volatile and it's not real strong these days, is it? It's pretty weak. In fact, the S&P 500 as traded by the ETF SPY, that's the Spiders ETF, it dropped down below 196 not too long ago, and it hasn't traded above that level since January 7th. Now, it's down and it's kind of having a hard time rallying back up in the face of high volatility. Now, what comes along with high volatility is more expensive options, because the implied volatility, what people are willing to pay for options, whether as protective devices or as speculative devices, rises. So options are pretty expensive right now. So a great way to capitalize on this scenario that we're facing right now is with the call credit spread. Now, since 196 is kind of the operative number that the stock hasn't been able to get above, the ETF rather hasn't been able to get above, here's the situation. I like selling the regular February expiration 196 calls, and at the same time buying the 199 calls at 70 cents net credit or better. So this is what you would call a call credit spread. It's the February 196, 199 call credit spread for 70 cents or better. So let's break down exactly how this all works. As long as this SPY stays below 196 by February expiration, which is, 3 weeks away or so, this trade is a winner. We want the stock to A, maybe fall, or B, stay where it is, or C, it could even rise a little bit as long as it doesn't go much above 196. So it's a high probability trade because a lot of different scenarios can play out for this trade to be a winner. So what I would do mechanically is, if I can, right now I'm selling the spread if I put this trade on. I'm collecting 70 cents. If at some point I can buy the spread back for somewhat significantly less, maybe 25 cents or 20 cents, I could take a pretty big chunk of profit out of this by shorting at 70 and buying at, say, 20. That's my objective. Not hold it until expiration and be a piggy and try and get every last cent out of it, but take a nice good chunk of profit and then move on to the next trade. Now, it's a high probability trade. My chances of being right are surely better than my chances of being wrong, just given a log normally distributed market. However, I could be wrong. What if the market turns around, some crazily fantastic news comes up, or some technical barriers are broken and the spiders rally above 196? Well, if that happens, I would have to do a little finagling here. I could either A, close the trade, might take a small loss if that happens, but if enough time passes, I might even still make a profit. Or I could simply adjust by executing a technique called rolling and roll up to a higher strike to give myself a little bit more wiggle room so the the ETF doesn't end up being a bust. If it goes to 196, it has more room. It can go up to, say, 198 or something like that before the trade runs into trouble. This is Dan Passarelli of MarketTaker.com here on the floor of the CME Group. And if you want more information about trades just like this one, generating income trades, surf on over to MarketTaker.com and look for our free ebook. Just click on the link in the top level navigation that says ebook, and we'd be happy to give you a free copy of an ebook, 6 ways to generate income using options. Trade well.